Have you been denied a loan to purchase a home due to bad credit? Or maybe you haven't even attempted to try and purchase a home because you know that your credit has some less than perfect spots on it and you don't want to even risk being denied a loan and going down that whole process just to be disappointed. Well, in this episode, we're going to be talking about credit, the impact that it has on you being able to purchase a home. How important is it really? And some of the things that you can do to repair your credit as well, or improve that credit score to get you closer to that approval that you're seeking to purchase that home. So to get things started out, we'll break down what your FICO credit score is. So when you go to purchase a home, FICO is the scoring model that the majority of mortgage lenders use when it comes to qualifying you for a mortgage. So your FICO score is broken down into 5 different parts, and that is your payment history, your amounts owed, your length of credit history, new credit, and credit mix. So your payment history is the biggest section that forms your FICO credit score, and that's 35% of your FICO credit score. The next section after that forms it is your amounts owed, which is 30%. Then length of credit history is 15, credit mix is 10, and new credit is also 10. So just between payment history and amounts owed, that's 65% of your credit score. Just those 2 items: payment history, your ability to make on-time monthly payments for all of the debts listed on your credit report, and amounts owed, which is how much debt do you have, particularly with those revolving lines of credit, i.e. credit cards. How high are the balances on your credit cards? Are your credit cards maxed out, or are they charged below 30% or below 10% of that credit limit? Those are things that are affecting your credit score the most. So that's what you really want to look out for and pay attention to when it comes to your FICO credit score and everything like that. But moving along, some of the things that are killing your credit, there are late payments, missed payments, collections, charge-offs, and inaccurate information. So on that, there are a lot of things that many people are unaware of when it comes to their credit, and oftentimes inaccurate information is one of those things. So everyone should, at a bare minimum, once a year be checking your credit report at annualcreditreport.com. This is the one website authorized by the federal government where you can obtain a free credit report at least once a year. Now, since the pandemic, they've actually been allowing people to get a free credit report every week. So you can actually get it more than once a year right now. But at least once a year, you should be checking your credit report to make sure that everything is accurate. You want to make sure there's nothing fraudulent on there. You want to make sure that all the information reported on your credit report is accurate. There are so many people that have inaccurate information, which actually leads to them not being able to be approved, or it just lengthens the process for them actually being able to purchase a home because they've got to get all that inaccurate information corrected. For example, let's say that you have your legal name, but on your credit report, there might be other names listed on there for you. Maybe a nickname, maybe a shortening of a name, maybe your full legal name is Benjamin Wilson, but on your credit report, it shows Benjamin Wilson, and then it shows Ben Wilson, and then Benjamin L. Wilson or Benjamin J. All these variations, and you want to have only one name showing up on your credit report, which is your legal name, the one that's matching whatever's on your driver's license, your social security card, those types of things, so that when you provide those identification documents to a mortgage lender to get approved for that home loan, when they pull your credit report, they can see that the name on the identification documents that you provided them with matches up with the name on your credit report. And that's one way that you can eliminate those issues. But outside of just your name, there are other things that are often incorrect for many people. Another common one that I see is addresses. There are a lot of addresses that show up on people's credit reports, and some of them you have no affiliation with. Some of them are addresses that you may have never lived in, or they may be addresses that you previously lived in, but you currently now are not associated with. You want to get those old addresses removed from your credit report, because those are going to be things that can lengthen the time frame it takes for you to get approved, because again, you have those old addresses that you may have stayed at previously, but now they're not your current mailing address. And so you want to have those removed. And there's a process where you can go by and dispute those or have them corrected with the credit bureau so that they can start reporting accurately as well. And another thing on the misname thing or the incorrect name spelling thing, sometimes one of the ways that you have incorrect spellings of your name or different variations of your name is that when you go to apply for credit, the person that's taking your application or inputting your information into the system, sometimes they type it in incorrectly, which is why sometimes you'll have a misspelled name. And when they report that incorrectly typed name to the credit bureaus or the credit reporting agencies, as they're referred to by law, then that's how you end up with a misspelled name on your credit report. Also, if you were to put a nickname on that application where you're applying for a car note or you're applying for, a credit card or a personal loan, whatever it is, and that nickname is what gets input into the system, that's how you end up with all of these variations. So there are different ways that those variations can get there, but the ultimate thing is that you want to have one name showing up on your credit report. You want to have one address showing up on your credit report, the accurate current address of where you currently live at. Not all of these other addresses which you have no affiliation with. So those are some of the inaccuracies that you want to get corrected, which can harm your credit. But getting back to some of the other items that we mentioned, the late payments, the missed payments, by all means, you want to make sure that you're paying all of your bills on time, because that's going to be a huge thing in terms of making sure that that payment history, which is the biggest section of your FICO credit score, that 35%, making sure that you get all of those points in that payment history by paying all of your bills on time every single month. Now, how many points is that? Well, your FICO credit score goes from 300 to 850. So that's 550 points, and 35% of those points is that payment history. So you want to make sure those payments are getting made on time. Not everyone, life happens to everyone. And if you come into a situation where you're not able to make the upcoming payment for a credit card or for a car loan or whatever it might be, reach out to the creditor in advance. Don't blow through that next payment. Don't just miss that next payment and say, you know what, I'll make it up the next week, because now you're getting a late payment marked on your credit report, and that's going to be something that's going to damage your credit score. Reach out to the creditor in advance and let them know, hey, I've run on some hard times. Whatever the situation might be, explain it. Hey, I recently got laid off of my job, but I found a new job and I'm starting that new job in 2 weeks. So within the next month, I should be getting my first paycheck, or within the next 5-6 weeks, I should be getting my next paycheck. Can you give me a break until then? And maybe I make 2 payments at my next pay mark instead of, and I'm able to skip this one. Or maybe you ask them if they can take that next payment and roll it to the back of the loan. So you essentially get a month break that you don't have to make a payment, and you just, skip that month and go to the next month. And by reaching out to the creditor in advance and working that out in advance, now you avoid having that missed payment or that late payment hitting your credit report and damaging your credit report, because you were proactive. And that's what I'm getting at. You want to be proactive in making sure that you do the things that you need to do to stay on top of things and protect your credit, avoid having those hits damaging your credit unnecessarily. So collections and charge-offs are the other 2 things that I mentioned that also kill your credit. Collections leads into when you have enough missed payments, you stop paying on a debt, then at some point it's very likely that the creditor that you owe money to is going to sell that debt to a collection agency. And when they do, now that debt is in collections. And so you might have a collection agency reaching out to you, trying to collect on that debt as well. And then if that collection goes long enough of not being paid, then that collection agency can charge it off as, a loss. Basically, the creditor that you owe money to can charge it off and say, you know what, this is a loss. I'm not going to recoup this. So they write it off as a loss on their books, and it becomes a charge off on your credit report at that time. But again, all of these stem from or start at a late payment. that turns into a missed payment, and enough missed payments turn into collections, and long enough of unpaid collections turns into charge-offs eventually. And so again, just starting at the beginning with making sure that when you have those payments that coming up, if you can't make them, try to work out a deal. And if maybe you need a little bit more time than just a 1 month break, then perhaps you try and negotiate for a remodified loan schedule to where now you have lower monthly payments. I was actually recently talking with an individual who did this for a debt that this particular individual had, which she was able to get reduced from what she owed to a much lower amount because financial situations changed and everything. So that's something that you really want to tap into. You do have that option to reach out to the creditor and say, hey, I've fallen on hard times. Maybe you only need a month, but if you need more than that, my financial situation has changed and I want to talk about working out a different payment structure or payment plan to where I have a lower payment amount and payments that are more manageable for you. And so you want to make sure, again, just being proactive with those things as well. So moving on from there, different ways that you can improve your credit. For the first thing, and I'm gonna put this up on the screen, but for those of you who are listening just on audio, this is the website, annualcreditreport.com. You want to make sure that you go to this website and get a copy of your credit report. If you haven't done it yet this year, then do it today. Go to annualcreditreport.com, get a copy of your credit report. It's free and you can get a copy of your TransUnion, your Equifax, and your Experian. I highly recommend you get your free copy of all three of those credit reporting agencies. And the reason is because there may be different stuff on each of those credit reporting agencies. TransUnion, Equifax, and Experian do not talk to each other. So information that gets reported to TransUnion TransUnion is not sharing that with Equifax and Experian, and vice versa. Equifax is not sharing with Experian or TransUnion. Experian is not sharing with Equifax or TransUnion. So they don't talk to each other. So that's why you can have one credit bureau or one credit reporting agency that reports certain information, but then you don't see that information on others, because also some of the creditors that you have agreements with, that you have a line of credit with, they might not report to all three credit reporting agencies. So they may just report to TransUnion, or they may just report to Experian, or Experian and Equifax, or 2 out of the 3. So you want to check all 3 of your credit reports to make sure that the information that's on there is accurate across the board. So that's the first thing in improving your credit, is pulling your credit for all 3 of the credit reporting agencies and making sure the information on there is accurate. Next, you want to, as we talked about earlier, correct all incorrect information, names, addresses. You could even request to have your employment information removed, because you might also see your employment information on there as well. If your employment information is incorrect, again, you want to make sure that you get that corrected. But you can dispute items that are also incorrect as well. Maybe you have late payments that are being inaccurately reported on your credit report. You can dispute those payments to have them removed. If you've got other debt amounts that are on there that are inaccurate, or you have other debts that are on there that just shouldn't be on there, period. Maybe it's not even your debt. You want to dispute those items, because you want to make sure they get removed from your credit report so that they are not negatively impacting your ability to be able to purchase a home, purchase a car, do whatever it is you want to do that requires you to have your credit checked or run by a creditor or someone who's going to extend you a line of credit. So negotiate, pay off for deletion. This is another thing that you can also do if you have a debt that you owe. One of the things, because again, and I will say this here, just because you remove an item from your credit report does not mean that you don't owe the debt anymore. It means that that debt no longer shows up on your credit report. For example, if you owe creditor A $2,000 and that $2,000 is showing up on your credit report. Maybe it's showing up as a collection or showing up as a regular trade line item, whatever it is. Let's say you dispute creditor A and say, hey, I want this debt removed from my credit report, and it gets removed from your credit report. That doesn't mean that you don't owe the debt anymore. That means that that debt no longer is negatively impacting your credit score, assuming that it was, having a negative effect because it was maybe some missed payments or late payments that was associated with it. But in any case, I want to make it clear that just because you have an item removed from your credit report to where you can no longer see it on your credit report, that does not mean that you don't owe the debt. It just means that that debt is no longer reporting on your credit report, but you are still potentially obligated to pay that debt. And depending upon what the debt is and who you owe, they could also seek, to get payment through, taking you to court to try and get payment that way as well. So just wanted to make that crystal clear. Removing items from your credit does not mean that you are no longer obligated to pay the debt. So now, when we talk about negotiating a payoff for deletion, what we mean here is that you can, let's say, using our example, $2,000 that you owe to creditor A. Let's say that $2,000 is in collection and you don't have $2,000 to pay creditor A off, but you're like, you know what? I do owe the debt. I want it removed from my credit. Let me see if I can two birds, one stone type deal. So what you can do is reach out to creditor A, preferably with a letter because you want to have something in writing. But you can also call as well. But I prefer for people to, do their disputes or their agreements or whatever. Having a paper trail of something is what I prefer. But I have also heard of people having success by calling the creditor and talking with someone on the phone as well. So either way, there are different ways that there's no one way to do it. There are multiple ways that you can get the job done. But ultimately, what you're going to do is you can reach out to them and say, hey, I know I owe you $2,000. It's currently in collection right now. I don't have $2,000. But I do have $1,500 or I do have $1,000 and I can pay you within the next 2 weeks. If I give you this $1,000 or I give you this $1,500, whatever it is that you have that you can comfortably pay them, and make sure you set a time limit on it, i.e. 2 weeks, 30 days. Preferably you want to keep it at least 30 days or less, but set a time limit on it. Hey, if I give you this in the next 10 days or the next 2 weeks, will you call the debt good, the debt's been satisfied, and remove this debt from my credit report? You want those two things in there. One, you want them to put in writing, yes, if you pay me the $1,500, then we will call the debt that you owe us satisfied, and we will remove it from your credit report. So you want those two things to happen, because again, just because it gets removed from your credit report does not mean that you don't owe the debt. So you want to make sure you get that in writing. And so if they do agree with it, get it in writing before you send them any money, because if you send them money and you don't have anything in writing, your agreement does not exist. It doesn't exist unless it's in writing. Get it in writing first, then send them the money over the next 2 weeks or whenever the time frame is that you negotiated with them to get that. So difference makers. Now we're going to talk a little bit about the difference maker for credit when it comes to having good credit, some of the things that it can benefit you with. So for one, down payment assistance. And I'm talking to the tune of $10,000 or more. I know some down payment assistance programs that are paying $15,000. There are some grant programs that are paying $20,000 for people to be able to help out with their down payment assistance and closing costs. But again, you need to have the good credit score in order to qualify for these programs. So for some of these programs, it requires a 620. For other programs, it requires a 640. It all depends on the program, but some of these programs also have good interest rates associated with them. Some of them you can definitely get interest rates that are well below the market rate right now. And so Having good credit has that benefit of being able to allow you to tap into those down payment assistance, and literally tens of thousands of dollars is money that you can access to help you be able to purchase a home and start creating that generational wealth. Now, moving on from there, lower interest rates is another thing that you can also get because you have good credit. If you've got bad credit, you're going to pay more in interest rate. You're also going to pay more in mortgage insurance as well if you have a conventional loan, because mortgage insurance or private mortgage insurance on a conventional loan is heavily determined. How much you pay in private mortgage insurance is heavily determined by your credit score. And so having that good credit can actually get you a much lower mortgage insurance premium or private mortgage insurance rate than what you would have had if you went FHA for your loan. So that's also pretty awesome, is that you can actually have a lower private mortgage insurance rate than what you would have had going any other option. So lower interest rates, down payment assistance, higher purchase price is another one that you can also have by having a better credit score. And what I mean by that is there's what's called an automated underwriting system that just about all mortgage lenders out there use when they are approving you for a loan or determining whether or not you can be pre-approved for a loan. They're taking all of your financial information and they're putting it into essentially a system that's looking through all of it and determining that, yes, you're automatically approved or you're not automatically approved. And if you're not automatically approved, then that lender may see if they can fit you into a manual approval where they bypass the automated underwriting system. However, how does that factor into the higher purchase price? Well, the higher your credit score is, the more likely that it is that you can actually have a higher approval amount. So for example, typically lenders can go up to 50% of your income to qualify you for a mortgage if you've got decent credit, if you've got good credit. So let's say that you make, let's just say $6,000 a month or $7,000 a month. Half of that is what a lender can use to qualify you for a mortgage, meaning the total debt that you can have going out toward paying your mortgage or your proposed mortgage payment, your student loans, credit cards, car note, all of that stuff can come up to 50% of your debt to income ratio. Now, if you've got credit that's not so good, then maybe you can't even use 50% of your income to try and qualify for a mortgage. You might only be able to use 40% of your income or 36% of your income. That number starts to go down. But let's say that you have amazing credit. Well, in that case, if you're going FHA, you might be able to use 53 or 55 or 56% of your income to qualify you for that mortgage. So that's why having great credit can actually get you, that's how having great credit can actually get you a higher purchase price, because you can actually have a higher debt to income ratio. And that's what we call that ratio between how much money you make and how much you pay every month in debt. That's your debt to income ratio. And again, 50%, meaning 50% of your income is about how much that usually a mortgage lender will try to keep you under in terms of how much of your income you can utilize to pay off debt. But if you've got great credit, there are ways that you can get a higher debt to income ratio limit to where you could go above that 50%, which means that you could qualify for maybe your dream home that you really want, rather than having to just purchase the home that you can get in now. And there's nothing wrong with just buying the home that you can get in right now, but you do have that optionality when you do have great credit. And it might also not cost you anything more to get that extra $30,000 to purchase that dream home, because again, you're also getting the lower interest rate. So now that you're having that lower interest rate and you have that higher debt to income ratio, you could actually get that home that you're really wanting without having to increase your monthly payment. And that's the beautiful thing about having great credit, is that you really do have those options of, you know what, I can go purchase a home that's $30,000 higher, but I also don't have to increase my monthly payment in order to do it, because I've got great credit and I'm getting a better interest rate because of that great credit. So Last thing, I like to show this slide in terms of the 1% difference. And again, if you're listening to this in audio, I'm gonna talk through it so you're not gonna miss a thing. But the 1% difference, $200 a month is about what 1% can save you, at least $200 a month. There are some instances in which it might be a little bit less, but there are a lot of instances in which it can be much more than $200 a month. But if you've got a $300,000 home that you're looking to purchase, you know what, you might save $200 a month by getting a 6% interest rate instead of a 7, or a 5% interest rate instead of a 6. So that 1% can save you $200 a month. But what could you do with $200 a month? I mean, that could buy you groceries. It could help fill up your car once or twice. It can do a lot of things to, help increase the quality of your life. Maybe pay some bills, utility bills that it can help take care of. So again, you can save that money. But what does that look like when you stretch it out over 5 years? We're talking $12,000 over just a 5-year time frame. The next 5 years is going to go by whether you save the money or not. So you might as well at least work on the credit so that you can save the money in the long run. But not only that, we're talking about $30,000 worth of purchasing power that you can get at a minimum. And again, I'm not going to say minimum, but you could have more. Again, there are some instances in which you could have less, but there are a lot more instances in which you could save a lot more than $30,000 just by lowering that interest rate 1%. So what a 1% difference means is that, let's say that if you could purchase a home at $400,000 at a 6% interest rate. Now, let's say that you get that same home at a 5% interest rate. You could purchase up to a $430,000 home and keep your monthly payment roughly the same. That's the beautiful thing about that 1% difference that you can get with your interest rate, is that you can purchase up to a $400,000 home at a 7% interest rate. But then if you get a 6% interest rate, you can go up to a $430,000 home with the same monthly payment, because that $30,000 is what's changing that 1% is what's making the difference in that $30,000 higher. And in some instances, it might be $35,000. If you get in a more expensive home, it might be $40,000. It all depends. But again, that's huge in terms of the purchasing power difference that it can make. And again, that $30,000, $35,000, $40,000 could be the difference between you getting the home you like and the home you love. And so at the end of the day, it's worth it for you to work on your credit. Your credit is something that you want to protect, something that you really want to take care of to make sure that it is accurately portraying you as an ideal person that a lender is going to want to loan money to, because ultimately that's going to help you build the generational wealth that's going to benefit you and your family for years and generations to come. So that's what I have for you. Thank you for taking the time to tune in. Hopefully you were able to get a lot from it. Join me on Tuesdays. I put this out all the time, but Tuesdays on YouTube, I go live 7 p.m. Eastern Standard Time. Every Tuesday on YouTube, I'm going live. And the whole idea of the live broadcast at 7 p.m. on YouTube is that I am putting out information that is going to save you hundreds and thousands of dollars on financing and anything related to you purchasing a home. I'm giving you all the tips and the tricks. So every Tuesday, I'm giving you another tip, another trick, another resource that you can tap into that will save you thousands and tens of thousands of dollars when it comes to you purchasing a home. So YouTube, you can find me at Frederick M Official. That's Frederick, Frederick M as in Mike, and Official. So Frederick M Official, that's at Frederick M Official on YouTube, and join us live. It's a great time all the time. Again, I'm going to start slow rolling out the previous recordings because I have not put those out yet in terms of you just being able to go back and rewatch those, but it's some really, really good information. I'm also going to be compiling all of that information into a book that you'll be able to access or purchase rather, which is just going to have all of the mortgage tips that I've learned over the years of being a mortgage loan officer and over the decades really of being a real estate agent. And so I'm compiling all of this information together so that literally for like the cost of a $20-$30 book, you'll be able to have information that's going to leaps and bounds pay for itself. I mean, a $20-$30 book that's going to save you tens of thousands of dollars, hundreds of dollars a month. All of the information I'm gonna put in there, I'm giving it to you for free on Tuesdays. So literally you can buy the book when the book comes out, or you can just tune in live on Tuesdays and get all of the information for free there as well. But in any case, thank you for taking the time to tune in. I greatly appreciate your valuable time that you spend, and I want to bring that value back to you. So hopefully you're finding a lot of valuable information in this. I'm going to continue to bring out information that, you know, I hope is bringing value to you and benefiting you and helping you along your journey. So take care, be blessed, and we'll see you in the next episode.